It's December 2024 and you have completely forgotten to do any tax planning this year. Are you out of luck? Well, maybe in respect to some items, but you've still got time before the calendar rolls over to 2025 to put some important things in place to ensure you are getting the best tax savings and value for yourself in this year. So if this applies to you, let's get going on to this episode. Welcome to episode 46 of the Tax Talk podcast. As always, your host, Jared Pallon for Legacy Accounting LLP in Alberta, Canada. What are we talking about today? Tax planning tips prior to the end of 2024. Like I mentioned in the intro, there might be some things that have gone by the wayside and you are not going to have options as far as planning for those particular items, but there are still a number of things that you can put into place or decisions that you can make that can give you that added benefit on your tax return when you come to filing in the following new year. So, without further ado, let's jump right into it. So, what are the four main things that we're going to be talking about today? Critical tax deadlines, investment strategy alignment, changes in your family or business structure, and then lastly, retirement and estate planning items. So, hitting on the deadlines first. There are a number of deadlines that are going to be coming quickly and you need to prepare accordingly. So, December 31st, 2024, there are a number of items that you need to get done before the end of the calendar year in order to get a credit or a deduction on your 2024 tax return. Big one, donations. Make sure you are reaching out to your local charities. Maybe you bump up your donation at the Christmas period, give them a bit of a boost. Reach out to these organizations and see if there is a need and that you can help fulfill that. That's going to give you an additional credit on that 24 tax return. Medical expenses. These ones are always a little bit frugal and frustrating to deal with on the tax returns, as you've got to deal with that net income threshold of 3%. But if you are anticipating some medical expenses coming up, it might be best if you've got the cash flow to get that done before the end of the year, comparing, what you've spent to date plus maybe some additional expenditures is going to get you up over that 3% net income threshold and allow you to claim a deduction. Whereas if you maybe split some of these expenses between a couple of calendar periods and don't have the dates lined up correctly, you might not be able to make a claim for those. Union and professional dues. Probably in a lot of cases, these are coming right off your T4. You might not have a whole lot of say in how you're paying for those. But if you are maybe a professional and you've got a license renewal, things of these nature, just ensuring that these are all up to date and that you keep the receipts, forward those into us to ensure that we can claim those on your personal tax return would be a prudent step to take. Investment fees and interest. Again, probably somewhat fixed within the portfolio that you are investing in. But if you do have a non-registered investment portfolio of some kind, as you get towards the end of the year, if you are needing some expenses on that side, it might be prudent again to speak with your broker just to ensure that you have kind of maximized your investment position as far as the tax side in the current year as you physically can, and then getting them to prepare those statements and forward those on to us in the new year when they become available to ensure efficiency and ease of access for us to get that return done. Spousal support payments. So these again need to be paid on a regular basis. So if you've missed some of these in the past, you're going to need to kind of get those cleaned up to get yourself back on side with the arrangement that you have. But just ensuring that you make that final payment in December and that you have the proper documentation in place to ensure deductibility. I would say that this is one of the higher audited areas by CRA. So you need to have an agreement in place. For all intents and purposes, you should have some backup as to the amounts that are going over to your ex-spouse, and ensuring that if CRA does send a letter requesting you to verify these items, that you have those backup documents ready to go. Political contributions. Similar to the donations, you've got till the end of the year to make these in order to get a credit on your 2024 tax return. If you are in a habit of giving some funds to a political party, whatever stripe that might be, December might be the time to do that. I know for a fact that come mid-ish December, I will be bombarded with emails from a number of parties looking for donations prior to the end of the year. They will be more than happy to fully explain the tax credit associated with that and how you can donate a decent size amount of money, get a sizable tax credit back. So really, you're not even giving them much money at all. So look for those emails in the coming weeks. I know that they will come. Again, student loans and interest associated with those particular items. So paying up any particular outstanding debt there, getting that interest expense in the current year. Again, you should get a statement from the particular provider or lender of that loan into the new year that we will need for preparation of your personal tax return. And then contributions to an RSP if you turn 71 in 2024. So this is basically the last kick at the can. If you've turned 71 this year, you need to have those RSP contributions in by the end of the calendar year. If you require some assistance from us in regards to that planning, make sure you reach out to us early in December, as the month gets pretty tight as far as deadlines. So have that plan in place and take advantage of that if possible and if applicable. And then in regards to just general RSP contributions, so this year, because March 1st lands on a weekend, you will have until March 3rd of 2025 with which to make a first 60 days contribution that will then apply and be counted on your 2024 tax return. So similarly, if you need some assistance in doing some RSP planning, good to reach out to us here at Legacy Accounting, as well as your investment broker, to ensure you've got the right contribution amount put into place before that March 3rd, 25 deadline. Up next, let's talk investment goals. So a very important vehicle that I feel does not get enough recognition and enough use, and I like to try and make this aware for all of my clients and anyone who I can chat with, is the tax-free savings account. It gives you some good flexibility for investing, whether it be for a short or long-term goal, and I think they are a very underutilized investment vehicle. So in 24, you can contribute up to $7,000 into that tax-free savings account. If you turn 18 before the year 2009, you will have a cumulative cap of $95,000 in 2024. It is very important, similar to an RSP, to ensure that you understand your contribution limit and that you're not putting funds in that go over that limit. So if you have taken some money out of that TFSA this year for whatever reason, you need to watch that you don't go and put a whole pile of money in there before the end of 2024, as that cap room has not reset yet. You need to wait until you get into 25 in order to see that full cap space open back up to you. Good vehicle to use. If you can get some funds in there, especially when you are younger, and just let those monies grow, you can see some significant long-term benefits from investing through that. And again, it is not just a savings account whereby you are going to receive 1% interest on the amounts that you put in there. It is a very flexible account that allows you to put your funds into just a general savings account, into a GIC, into a broad range of mutual funds and various other portfolios. You can buy single stocks in publicly traded companies. And to my knowledge, if you structure things correctly, there is an ability to put private corporate shares in there as well. That is a bit more of a difficult item to put together, but that can be done as well. So do not consider it just to be a simple savings account, quote unquote, but it is a powerful investment tool that you can use to generate some wealth on a tax-free basis. Up next, we've got a couple of items on family situation that I like to talk about. So in respect to the province of taxation that is going to apply to you and your family, it is always the province of residence of you and your family on December 31st of that particular calendar year. So if you live in Alberta on December 31st of 24, it doesn't much matter if you move to BC or wherever on January 2nd. You are going to be taxed as an Alberta resident on your 2024 tax return. So if you are planning a move, it may be beneficial to time this accordingly. Provinces have different tax rates, so you might want to either delay a move or maybe push a move up if you are going to be doing this irregardless, and you could take advantage of tax rates in a particular province dependent upon what your presumed net income is going to be for the year. Kind of in the same vein is a house sale. So for the last number of years now, CRA has required you to report your principal residence sale on your tax return. Now, if this is your only house for the duration of the period that you have owned it, it is going to be covered under the principal residence exemption and therefore not be tax applicable. You will need to provide us with the year that you purchased it and the proceeds that you received on sale so we can report this on your tax return. Keep in mind, as a bit of a off note here, that they have really cracked down on the house flipping side of things. And if you are buying a house and disposing it within 365 days without having a exemption to protect you within the principal residence regime, you are going to end up having the income on that particular house be classified as business income, which is then subject to CPP. So unless you are moving for some, what I like to call major life reason, that being, a relocation of a job, a divorce, a death in the family, things of that nature, you are going to be forced into reporting that as business income. So keep that in mind when you are buying and selling property, not only now, but going forward. Into the retirement and estate planning sphere of things. So we had discussed the RSP options. If you're turning 71, getting that done by the end of December, and for all other folks, ensuring that you have those contributions in by March 3rd of 2025. As we mentioned with the TFSA, it's important to understand what your contribution room is with respect to that RSP to ensure you're not going over that. You would then be subject to penalties. And cruelly, you have to calculate your own penalty with respect to an overcontribution in the RSP program. So I find it a little bit of an extra kick while you're down. Not only do you have to pay a penalty, but you have to calculate your own penalty. And it is a very ignorant form to fill out or have us fill out. So do not over contribute to your RSP. You can simply check your prior year tax return to get that contribution amount, or you can go online to CRA through your My account and check that information as well. So how does an RSP work in very simple layman terms? So if you were to contribute $1,000 to an RSP, and if you lived in Alberta and you have income within the fourth tax bracket, so that is going to be taxed at 38% on regular income, so wages presumably, you are going to see a deferral of tax of $380. So what is the purpose of doing this? So if you are in that fourth tax bracket and you put some money into an RSP, you defer tax on that, you are able to grow those funds then tax-free, with the intent that some way down the road, when you take those monies out, your income will be in a lower tax bracket. So not only do you get the advantage of the deferred growth on that and the tax-free growth, you could then see some permanent tax savings through the earning of that income in a higher bracket and then actually paying tax on it in a lower bracket. Are RSPs for everybody? I do not believe so. Are they right for you? Potentially. Is it important to talk to us and an investment broker to figure that out before you blindly put some money into RSPs? 100%, that would be the best way to proceed. A couple of other planning considerations to look at. So an RESP is an option for saving for your child's post-secondary education. You can contribute up to $2,500 per year to gain access to the Canada Education Savings Grant Program, which can add an additional $500 to your RSP each year, up to a maximum of $7,200 for every beneficiary under 18. If you can't make contributions to that RESP prior to the end of the year, that grant can be carried forward into subsequent years. In regards to this, I always remember what an investment broker told me a number of years ago. When you're planning for things such as your retirement and post-secondary education for your child, chances are your child is going to have more opportunities to fund their post-secondary education via options available to them than you potentially have to fund your retirement. And what do I mean by this? So I know for myself, my parents had a bit of money saved away that covered the first couple of years of my college education. And then afterwards, I worked full-time in public practice, and my employers paid for my education as I went through the various degrees, designations, etc. So, to me, it was more beneficial then that my parents have money set aside for their retirement, and I'm able to go out on my own and fund my post-secondary education myself. A lot of this is going to apply in the trades as well. You do some schooling through the various program years for that, but on the times that you're not in school, you're working through that. So you've got the ability to support yourself while you're working through these programs. And I would always encourage students to do this if at all possible. If you can get into that program and find a career or a position within that eventual career, that you can gain some experience while you're working through those initial years of the education. And I think it's hugely beneficial to when you ultimately get that degree or designation. So that's something to kind of keep in mind. If you have put an exorbitant amount of funds into a child's post-secondary program and you haven't planned for your own retirement, you might be in a particular place that you're not comfortable upon retirement. So think about that. I do understand that college and universities are expensive. They keep going up, especially even since the time that I was involved in that aspect of life. But I think there are options for kids to, kind of quote unquote self-fund their education as well. So plan for yourselves as well while keeping your kids in mind. Tax installments. So if you had tax of $3,000 or more on your 2024 tax return, i.e. a payable at that point in time, CRA would have been expecting tax installments from you throughout the year. Those would have been due March, June, September, and now the last one for 24 would be due December 15th. So ensuring that you make this final payment by that deadline should help you in respect to installment interest charges down the road. Any interest from CRA is non-deductible. I know the rates have come down a little bit over the last little bit with the Bank of Canada dropping rates as well. That translates into drops with CRA as well, but the rates are still quite high, and being as the interest isn't deductible, it's kind of a waste of money if you're giving the government additional funds. And then lastly, making sure that you have maximized your charitable donation position with respect to overall cash flow. So you obviously don't get a dollar for dollar deduction. Every dollar I put into a charity doesn't result into a dollar of savings in tax. I wish it worked that way. We would be able to fund local projects and probably use our dollars much more efficiently by funding projects that we find valuable within our communities and that are more efficiently run than government bureaucracy plans. With that in mind, in Alberta, you can receive a credit of 15% for the first $200 in donations each year, and then 29% thereafter, and up to 33% for those in the top tax bracket, and that relates to the federal credit only. The last item I want to kind of touch on, the other kind of planning opportunities, is the first home savings account. So this is relatively new. It's a bit of a hybrid between the tax-free savings account and an RSP, and it gives individuals who have not owned a house before the ability to save some funds in a new investment vehicle. So if you are at least 18 years old and under the age of 71, again, haven't owned a home in the past 4 years, you can open up this first home savings account and contribute $8,000 annually to it, to a lifetime contribution amount of $40,000. So what you need to be aware of in respect to this program is it's not similar to the tax-free savings account, whereby you are granted that contribution room each year automatically. You need to ensure that you go and open up one of these accounts with a bank or a broker of some kind, and then you are granted that $8,000 contribution room in that particular calendar year. Now, if you don't have $8,000 to put into it by the end of December of 24, that's fine. If your intent is to start saving, I would firmly suggest that you go and open the account before the end of the year. That will give you access to that $8,000 this year. So when 2025 rolls around, then you will have $16,000 that you could contribute to. So it's important to get these accounts opened up as early as you possibly can. Whether or not you can put the funds into it now or down the road, at least you are going to have access to that contribution room when you want to. Check out the blog that we have on legacyllp.ca for some additional information on that first home savings account as well, how that kind of interacts with your RSP account, and how you can use that to ultimately fund that first home purchase. So in conclusion, what I always like to tell my clients is tax planning is not a once a year event. It's not a once in a lifetime event. It should be a regular and continuing event that you are always focusing on. If you put a plan into place 1 month out of the year, you're potentially leaving 11 months of opportunities on the table. But like I said from the onset, there are some items that we have discussed here and that you can view in that blog that can be beneficial to you before we close out December of 2024. And maybe it'll give you a bit of insight into some things that you can plan for come 2025 to ensure you're staying on top of your tax planning options on an ongoing basis. We don't want to be giving the government more money than they need to have. So put that plan into place, like I say, and then amend it on a regular basis to ensure you're minimizing your tax and maximizing your after-tax cash. So for Legacy Accounting, Jared Pilon here. Happy to bring you another episode of the Tax Talk podcast. Again, hope it was informative and you can put some of these tax planning tips in place before the end of the year. Thanks again for listening or watching. Feel free to touch base with us at Legacy in Alberta, Canada. Phone number here is 403-343-7707. Alternatively, you can reach us at reception@legacyllp.ca if you've got some personal tax inquiries into the upcoming tax season. Thanks again for listening. Take care, and we will talk soon.